Thanks for clicking. The United States may have to put a cap on bond yields, effectively restarting the money printer. This according to Lyle Needens of Investopedia, as well as Bloomberg, following Thursday's dismal 30-year bond auction.
And they expanded their balance sheet massively in the period after the great financial crisis. Is that a backstop that's available to the U.S.?
Indeed, on Thursday, the U.S. was set to auction off 30-year debt and was met with massively weak demand, with primary dealers, or the banks, forced to pick up 25% of the issuance, well above the 11% that the banks usually purchase. As we've talked about before on this channel, and will again today, no one wants long-term U.S. debt. Yields on the 30-year Treasury rocketed upward following the auction, and of course, yields on Canadian government bonds surged upwards as well. In fact, yields on Canadian government bonds rallied almost as much as they fell on news that our own economy was slowing and the bank was done cutting rates.
I'm what counts out here.
Yeah, these auctions are becoming more and more important, having more of an impact on Canada than our own monetary policy.
Should we be writing this down?
Yeah, especially if the US turns the money printer back on. So what I want to do today is go over Thursday's Treasury auction, take a look at those discussing a cap on US bond yields or yield curve control, discuss how that would work in practice, and then go over how that would impact us here in Canada. Speaking of us here in Canada, we are still awaiting October's national real estate data set to be released by the CREA any day now, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the money printer. So, what happened at Thursday's bond auction? Recall, prior to the auction, the US had announced its refunding plan. Its plan to borrow more on the short end of the curve, borrow short-term debt, and rely less heavily on the long end of the curve. Rely less heavily on long-term debt, using your credit card instead of getting a loan. Prior to this announcement, there had been weak demand for long-term US Treasuries, long-term US debt, which sent yields and interest rates skyrocketing higher for the past month. But the announcement from the Treasury that the US would be relying more on short-term debt seemed to work, with yields on 30-year Treasuries falling 30 basis points in a week. In shorter-term auctions, that shorter-term debt, which the US is going to rely on more heavily, going off as expected. So, the US is borrowing more short-term debt, and investors were happy to lend it. And Canadian yields and mortgage rates fell on the auctions as well, with it looking like the US plan was going to work, the US borrows more short, and we all get lower interest rates.
Predictable as ever.
And then came the real test at Thursday's auction of 30-year Treasury bonds. Now that the US was going to be borrowing more on the short term, reducing the supply of long-term debt, was there going to be a greater appetite for long-term US debt? And we got our answer, no, there wasn't. There was weak demand at that auction, sending the yields on those treasuries rocketing 20 basis points upward. As it turns out, your mortgage lender doesn't like it when you put the down payment on a credit card.
Give me a call.
So, declining demand for US debt due to its structural deficit, which we've talked about so many times on this channel, sending yields and mortgage rates and interest rates higher. And this has some arguing that if demand in the market just isn't there for US debt, then the Federal Reserve might have to step in and buy up US Treasury bonds, effectively putting a cap on interest rates, putting a ceiling on how high interest rates can go for now.
Be my friend.
So, what does that look like? How does the US put a cap on interest rates? Does Jerome Powell just walk the money printer into Janet Yellen's office and then we're off to the races? First, let's briefly recall that bond prices and yields are inversely related. So, as the bond price rises, its yield drops. So, let's say the government offers me a 1-year bond and at the end of the year they're going to pay me $100. I pay them $95 for that bond. I'm yielding 5.13%. But let's say I'm worried about the government's fiscal policy. I'm worried about inflation. So I'm not willing to pay $95 to get $100 in a year, as I don't think I'll get the purchasing power. So I only offer the government $90. I've now increased my yield. I'm going to be yielding 10.5%. But, and here's the important part, the government doesn't want to pay 10.5%. It really can't pay 10.5% for that matter. So, the government's good friend, the Federal Reserve, comes along and tells the government they'll pay them $96 for those $100 return bonds. They'll pay $96 and they'll buy as many bonds as the government wants to issue, which effectively sends the yield down to 4.1%. So now, if I'm out in the market and I want to buy a government bond, I have to compete with the money printer that's willing to buy up any bond for $96. As such, the government isn't going to sell a bond for anything less than $96. And with the yield on that bond being 4.1%, the government has effectively, the Federal Reserve, the money printer, has effectively put a cap on yields at 4.1%. Yields are not going to drop below that 4.1.
Dear Santa.
And that's how yield curve control works. The central bank controlling how high yields can go by overpaying, by paying above market price for government bonds. And this has been done before. The US government did it during World War II when the Federal Reserve helped to cap short-term and long-term yields. And Japan has also been doing yield curve control up until very recently, as they fought a deflationary spiral, meaning that Japan did it to fight deflation. Japan was trying to cause inflation. Japan was trying to cause prices to rise, as Japan, and almost everyone else, knows that money printing causes inflation.
It doesn't.
And I stress this point with Japan as I think it's important to do it early, as if the Federal Reserve does implement yield curve control, if the Federal Reserve does start buying up bonds, then we're going to hear in very short order from the usual suspects that Japan did it and didn't see massive inflation.
Yeah, he got me.
Yeah, despite article after article after article showing why Japan's economy was able to print money, was able to engage in yield curve control, and didn't get inflation. But inflation would be the case here. Simply put, financing the US debt via money printing would in fact cause inflation, as it would involve expanding the money supply. We all saw what happened with inflation in the US and here in Canada as our governments increased the money supply substantially. And that supply has been falling both in Canada and in the US since the summer of 2022 when the CPI hit 9%. However, were the Federal Reserve to restart the money printer, start buying up government bonds, again putting a cap on yields, that would expand the monetary base. That would expand the money supply with no corresponding increase in production. That money supply would get out into the real economy as the government took that money, borrowed that money from the money printer, and spent it. And obviously we can understand how this could get out of control very quickly. With the government printing more money, spending more money, we get inflation, we get even less demand for US bonds from the market, and then the Federal Reserve has to print more money. Then the Federal Reserve has to buy up more bonds, and on it goes.
This time, it will be different.
And that's not even to mention that if the US started to monetize its debt, outright print its way out of its debt problems, then that could lead to further downgrades of US credit, in addition to the ones that we're already seeing. So, is the US going to restart the money printer? Well, according to Bloomberg, if faced with the choice, if faced with defaulting on its debt, not being able to pay its obligations, not being able to borrow from the market, if it's between that and the money printer, between the money printer and the inflation that comes with it, the US will choose the money printer.
So we think in a crisis type of scenario, the Fed's going to be in a very difficult spot because, of course, it's going to look like if you have a Treasury crisis that the Fed is monetizing or bailing out the government in some way. But on balance, we think that their commitment to financial stability will win out, and they probably have to step into the market to quell fears, as we saw in the UK crisis.
Yeah, and as we've talked about on this channel, and we've seen over the past few days, weeks, months, and decades, what happens in the US very much affects what happens here. If the US were to implement yield curve control, that subsequent inflation that would come to them surely would move north of the border to us as well. And I suspect, at least initially, that 4.1% cap that the Federal Reserve would have on US yields would also be the floor on our yield. Investors aren't going to accept a lower yield on Canadian bonds when they can get 4.1% from the Federal Reserve, from the world's reserve currency. For now. With that said, we will continue to track how the US is managing its debt and of course the impacts on Canada stemming therefrom. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.